What I'm going to go over here is a little bit of research I recently published, but I'm not going to, what this is going to be for is for undergrad or MBA students that are interested in a research project. So I'm going to start to give you an idea of what are some unanswered questions and what are some data sets that you can use. So I won't dive into a lot of the modeling, the econometrics of what I'm doing. It'll be a broad overview, like I said, most interesting to undergrad MBAs looking for applied research projects. So what we're going to look at here is the effect of bank regulatory capital levels on loan types. There's a lot. Before I go into it, a little plug on doing research in banking. Since 2008, we had our most recent financial crisis. We now have 10 years of data, so we are now able to sit back and look at the response and ultimately the response from regulators and the Fed, and we can test how their reaction to the financial crisis worked out. Also, it is an interesting time in banking. I'll show you this chart here. I'm going to refer to this where I have a lot of data sets. But before we go in, just looking at this chart here, what you can see is this is the number of bank deaths. So this is a bank that has been acquired or failed. So banks ceasing to exist is this purple line. This is I guess it would be like greenish orange line is the number of new banks. So this is bank births, and this is the net down here. And as you can see, on average, well, recently we've been losing about 80 banks per quarter. Roughly speaking, back in 1992 in the United States, we had about a little over 13,000 banks. Now we have a little over 5,000, so a greater than 60% drop in the number of banks. And a lot of times people will say, well, this is because of consolidation and so forth, where in reality that's not quite true. As you can see, this is going back to 2002, we've had fairly consistent consolidation. However, what has really happened is we've stopped creating new banks. So what you can see here is consistent bank consolidation or bank failure. But however, in going 2013 onward and really starting to dive in 2008, we've had pretty much zero bank creation. So we're losing about the same number of banks. We're just producing fewer. So this is going to be an active area of research going forward. This is something that I think undergrads or MBAs can really start to look into and try to see what's causing this and the also the ultimate effect on the economy. So we'll talk a little bit about the data set as we go through the presentation, but now I'll jump into a little bit of the research. So what we're going to do here is we're going to look at what this analysis does is test whether regulatory capital levels and whether these capital levels are risk-weighted affect the loans that the bank originates and holds. So as a bit of background, if you're new to banking, we require banks to hold regulatory capital. You can think of this as equity, right? So the idea here is a bank, your typical thrift, will take in deposits and it will give out loans, it will originate loans. So if any of those loans fail, right, if it only took in deposits and originated loans and held loans, if those loans fail, then the bank could not repay depositors. So, this is not something that's acceptable. So the idea is a bank has to hold regulatory capital. If you remember what equity is a residual claim. So you only get what is left over. So any losses will first hit regulatory capital, meaning the equity holders lose. And then only if all the equity was wiped out would the depositors lose. So what regulators are saying is, well, we had bank failures and banks that needed to be bailed out in 2008. So there's a lot of talk on raising regulatory capital requirements. Also, since Basel II and particularly after the financial crisis, regulators have talked about risk weighting assets, saying, okay, well, you shouldn't look, we shouldn't treat all assets the same. We should risk weight them, so we're taking into account the risk in your balance sheet, not just the size of the balance sheet, if you will. So Post-financial crisis, again, regulators are talking about raising regulatory capital levels and risk weighting. So we're going to say, now that we have enough data, we're going to say, okay, well, what's the effect of, regulatory capital levels and risk weighting on the amount of commercial and industrial loans, consumer loans, and real estate loans a bank will originate and hold. So here's a little bit of the literature. I won't go into this. If you were, producing academic research here, this would be interesting to you. But I'm going to skip that. Now, a little bit of motivation. This is in the 2018 regulation. They proposed a regulation which would set a required Tier 1 leverage ratio of 9%. Tier 1 leverage ratio is Tier 1 capital divided by total assets of 9% for a bank with less than $10 billion in assets. So this is what we're doing here is trying to get the regulatory capital levels right. So this is an active area of regulation. These are questions that these are things that we're trying to get right now. So doing research in this would be put you in an area that where your research is in demand. So goal of this analysis, first we'd like to confirm the link between levels of regulatory capital and the quantity of bank credit. So what we're going to test here is if you increase regulatory capital, will banks lend more? Meaning if they have higher levels of regulatory capital, they can lend more. They have the ability to, but it's not clear that they actually will. There are some reasons why a bank may not originate more of these loans. One colleague of mine, said, well, bank, if they have excess capital, they just may buy treasuries. They mean a loan to the treasury. I don't think that's true, simply because any CEO of a bank that simply takes the deposits and buys treasuries and lends to the U.S. Treasury, they wouldn't really be doing their job. So I think the banks really want to do their core role in the economy of originating loans to businesses. The other reason why it's not clear that this relationship would be positive is bank capital is costly. So what might happen is if we say you have to hold a higher level of capital against your loans, a bank might say, well, shoot, I'll just have fewer loans instead of raising more additional costly capital. So while my hypothesis is this relationship will be positive, it's not, it's not clear. And then we want to look at, whether the level of capital has a effect on the type of bank credit offered, and also whether risk weighting affects the types of loans a bank offer, right? And this is going to be the really important one. Good. So what we're going to use here is Tier 1 leverage ratio. Again, that's Tier 1 capital divided by total assets, and we have also the Tier 1 risk-based capital ratio, and we have these for all banks. I'll talk a little bit about the data. That's the Tier 1 capital divided by risk-weighted assets. An interesting note here. This is Haldane 2011. I need to write a little JavaScript here to put in the citation. I'm using BibTeX, but the idea is he was a Federal Reserve official, and I'm citing a speech by this Fed official, and he noted that the number of calculations it takes for a large bank to calculate regulatory capital where the risk weighting assets is approximately 200 million. So one of the things to keep in mind is when we switch from Tier 1 capital, Tier 1 leverage ratio to Tier 1 risk-based capital ratio, there may be a few calculations with Tier 1 leverage ratio, but like I said, for a large bank there could be hundreds of millions of calculations for once we start risk weighting all the assets. So that is, again, that's a downside. That's not to say we shouldn't risk weight assets. It's just to say the more calculations we need to do, the less confidence, let's say, we have with our calculations. Also, we generally tend to risk weight things by looking at what was risky in the past. So once we have these risk-based capital ratios, we're incorporating what recently happened into our risk weighting, so we have the tendency to fight the latest battle or the latest financial crisis. We'll tend to weight things that failed recently and as risky, and possibly pushing too much capital into areas that have not historically been risky, but then become risky. So that's a little background on risk weighting. So data. So this is going to be important for you if you want to do some independent research here. And again, the research that you can do with this is not simply you could write articles that could go to something like Seeking Alpha and so I'm not talking about academic research. This is research that might go to which banks to buy and for investment portfolios and so forth. But what I'm using here is the call reports. Every FDIC insured institution has to file call reports. So these are financial statements, but they are much more detailed. So what we can get is the amount of derivatives, interest rate swaps. We can get ATM fees. We can get quite a bit, and I'll go through a little bit of what I use in this analysis. So here we can get commercial, industrial loans. What I have here is the code and the schedule on the call report where I'm getting the data. So we can see how many credit card loans a bank has, other revolving, so auto loans, and so forth. We can see real estate loans by type, 1 to 4 residential, farm, loans for farmland, loans for multi-residential, meaning more than four families. One thing I wanted to go here is, one thing is there's talk about a recession, and one interesting thing, if you want to do just timely analysis on what's going on in the economy, if you want to see if a recession is coming, one of the best places to look, in addition to the yield curve and so forth, is you should see it in non-performing assets 30 to 89 days overdue. So generally when we head into a new recession, financial crisis, you'll see these spikes. So you can do those types of analyses with this data set. Good. This is a little bit so now before I move on, let me talk to you about where you can get the data set for this analysis that I'm going to do. So I have built panels. So this is a built panel that I'm using for this analysis, this full panel RDS. So it is in this my GitHub call report. So the actual data set that I built for this. So if you want to use a variable that I have included in the analysis, you can just pull this full panel RDS. What an RDS, the reason why this is stored as an RDS is I'm running panel data models which require objects of a class PLM. So basically I'm saving this when it's imported. If you've loaded the library PLM, it'll import it as a object of class PLM, which you can then feed directly into a regression. If you don't use R and you use Python, I'm happy to just output this as a CSV. Then I run some fixed effects models, even though R is a bit better. I do run some in Python. And I can output this for you in CSV, and then if you're not able, you can read it in Python. But the nice thing about an RDS file is it keeps its class. Okay. Now, one more note before I move on. This is a repo that I don't use anymore. I originally built these this call report database off of FFIEC call reports, which are a little bit harder to use. I did find a new data source, and they only have the data from 2002 onward, but I found a new data source at the FDIC where they upload the data as a CSV file. So that is, so I'm rebuilding this data set, and off of that data source in my GitHub. It's you can just search for FDIC and you'll see FDIC SDI data, and that's the repo where I'm building the new data set. And the benefit from that is, one, it's easier it's going to be easier to use if you want to build your own panel, but also it has data from 1992 onward, so you'll be able to have 1992 until today. Good. So method, I won't go into too much. This is my equation. I'm using fixed effects with time and bank fixed effects. So I'm looking at the percent change in the particular loan type. That's my dependent variable, and my independent variables are some controls, total equity, and then a capital ratio, which is orthogonalized to total equity. If anyone's interested in that, you can ask, and I can tell you about that. Maybe say something in the comments. I'll do a brief video on why I orthogonalize a variable. Good. But what it gives me, the idea of orthogonalizing this variable is I'm looking at tier 1 leverage ratio or tier 1 risk-based capital ratio independent of total equity. So I'm looking at only the information in the leverage ratio, which is not already in total equity divided by total assets. So skipping over to the results. So also, of course, the relationship between capital and lending will be nonlinear given capital threshold. So I also estimate all these regressions for well and poorly capitalized banks. So the idea here, if a bank is poorly capitalized and they increase their capital, I don't expect them to lend more because they still haven't hit the threshold where they are adequately capitalized. So our analysis is, we're mainly concerned with those well-capitalized banks. And what we should see, and what we do see, is that the relationships don't hold for poorly capitalized, or they hold less so because, again, they are hoarding capital to get up to that capital level, and they can't lend more. So going through the results, this is non-risk weighted. This is tier 1 leverage ratio. What we see is a higher tier 1 leverage ratio should increase the amount of commercial and industrial loans. We also see it increasing right here, 2.8, positive and significant. We also see it increasing the number of consumer loans and the number of real estate loans. So across the board, higher tier 1 leverage ratios increase lending to commercial, industrial, consumer loans, which credit card, auto loans, so forth, and real estate loans. However, once we shift to risk weighting our assets, then a higher risk-based capital ratio will indeed again yield higher commercial industrial loans. However, this is negative and significant now. It will lower consumer loans, and it's also going to lower real estate loans. So the idea here is once we start risk weighting assets, we are shifting money away from consumer loans and real estate loans and to commercial and industrial. So we see the effect that risk weighting has. The remainder of these here go into well and poorly, and you can scroll through and see that they're as you would expect. So ultimately what this research is saying is, yes, higher regulatory capital levels will lead to generally more lending. However, if they're risk-based, then you tend to shift that lending away from consumers and real estate and toward commercial and industrial, which is again consistent with the recent financial crisis, what we deem risky from that. So this is the conclusion, just what we talked about there. So again, hope this gives you a brief introduction to doing some research in banking and some data sets that you can use. If you want the data set that I used here in CSV, the best way to probably interact is not a comment on the YouTube video. I don't see those often. Probably the best way would be to issue a pull request. Open an issue on GitHub. So open an issue, say, hey, can you give me that in CSV, and I'm happy to do so. Any other questions you have, also definitely feel free to open an issue on the repository. If you write a comment, I'll try to respond. But GitHub's the best way, and also if you want to link. Feel free I can show you the FDI. Let me show you just briefly before we go the new data set. So using a new keyboard. FDI all SDI data. So this is where I'm creating this one in Python, but so the data isn't here, the raw data, because it's too much. So what I've done is create a script, and then I'm in the process of merging the data into panels. So once I have the panels, the new data set will be up here. And again, the neat thing here is it's from 1992 onward. So a lot more data, and this should be up to date. Have a great afternoon.